Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Atlassian started in 2002 in Sydney, Australia, when two university friends, Mike Cannon-Brookes and Scott Farquhar, maxed out a $10,000 credit card to start a software company.
Unlike most tech startups, Atlassian was profitable at IPO in 2015.
The core product is Jira, a project and issue tracking system that became the standard tool used by software development teams worldwide.
Confluence is the second major pillar, a team documentation and knowledge base platform.
The product suite also includes Trello for lightweight Kanban-style task management, Bitbucket for code version control, and a developer operations platform called Jira Service Management for IT teams.
Revenue splits roughly 72% cloud, 27% data center, and a declining sliver of legacy server. Cloud revenue is growing approximately 25% year over year as customers migrate off on-premise deployments.
The server end-of-life announcement in 2022 was a deliberate strategic push. Atlassian essentially told customers, your on-premise server licenses are expiring, move to cloud subscriptions or self-hosted data center deployments.
Gross margin runs approximately 82%, reflecting the high-margin nature of software subscriptions. Net revenue retention of roughly 130% means existing customers are expanding usage faster than any churn occurs.
The low-touch, no-direct sales model is structurally unusual for enterprise software. Atlassian built distribution through developer communities and product-led growth. Teams adopted tools bottom-up before IT approved them company-wide.
Atlassian has over 300,000 customers across enterprises of all sizes. The marketplace of over 5,000 third-party integrations deepens lock-in because customers build business processes around those integrations over time.
Mike Cannon-Brookes has been co-CEO since founding and remains deeply involved in the technical direction of the company. Scott Farquhar stepped back from the co-CEO role in 2024, leaving Cannon-Brookes as the sole CEO.
Competitively, Atlassian faces Microsoft's Azure DevOps and GitHub, ServiceNow for IT service management, and newer entrants like Monday.com. Its moat is workflow depth, years of customizations that competitors cannot import easily.
The cloud migration story is the dominant financial narrative. Server customers converting to cloud subscriptions recognize annual recurring revenue on a predictable basis, replacing lumpy perpetual license fees and improving revenue quality significantly.
The long-term financial model targets non-GAAP operating margins improving toward 25 to 30% as cloud scale creates operating leverage. The business is investing heavily now in product development to sustain cloud growth.
Atlassian is embedded in the software development process of hundreds of thousands of companies. That workflow dependency is one of the most durable forms of enterprise software lock-in in the entire technology sector.
Key metrics to follow: cloud revenue growth rate, data center to cloud migration pace, and net revenue retention. Those three tell you whether the business is compounding on schedule or losing ground to competitors.
That's the company chapter for Atlassian. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Atlassian just posted Q3 fiscal 2026 revenue of $1.79 billion, up 31.7% year over year, and above every estimate on the street. Non-GAAP EPS of $1.46 beat the $1.33 consensus by nearly 10%. Free cash flow over the trailing 12 months hit $1.21 billion. The cloud migration engine is fully firing, and Atlassian Intelligence is pulling enterprise accounts deeper into the platform.
Atlassian was founded in Sydney in 2002 by Mike Cannon-Brookes and Scott Farquhar, who bootstrapped the company with credit card debt before taking it public on NASDAQ in 2015. The thesis was software teamwork infrastructure, tools that let engineering, IT, and business teams coordinate at scale. Flagship products include Jira for project tracking, Confluence for documentation, Trello for Kanban workflows, and Jira Service Management for enterprise IT service delivery.
Cloud revenue now exceeds 80% of total revenue, up from a server-heavy mix 3 years ago. The server product line hit end of life in February 2024, forcing legacy customers to migrate, a structural tailwind compounding cloud ARR for 6 consecutive quarters. Market cap is $18 billion at a share price of $68.59. No dividend, capital is reinvested into AI and platform growth.
Q3 fiscal 2026 revenue of $1.79 billion grew 31.7% year over year versus $1.36 billion in Q3 fiscal 2025. That is the headline beat. 31% growth at this revenue scale is rare in enterprise software. Non-GAAP EPS of $1.46 cleared the $1.33 estimate by 9.8%. GAAP EPS was negative 37 cents, entirely explained by stock-based compensation accounting that does not affect cash generation.
Gross margin reached 84%, SaaS quality economics that most enterprise software peers would envy. GAAP operating margin was negative 3.1%, inflated by SBC. Non-GAAP operating margin was approximately 27%, demonstrating the underlying profitability of the cloud business. The GAAP loss is a narrative issue, not a financial one.
Free cash flow on a trailing 12-month basis reached $1.21 billion. Operating cash flow over the same period was $1.25 billion. These are the numbers that matter. Atlassian is generating more than $1 billion in annual free cash flow while simultaneously investing in Atlassian intelligence and platform expansion. The business model is working.
Balance sheet, cash of $1.14 billion, debt of $1.24 billion, net debt of approximately $107 million, essentially balanced. Book equity is $879 million. The company has the financial flexibility to invest in AI without needing external capital, which matters in a higher rate environment.
Valuation? At $68.59 per share, Atlassian trades at a price to sales of 2.92 times on trailing revenue, which looks inexpensive for a company growing at 31% with 84% gross margins. Price to book is 20.5 times. Forward PE on non-GAAP earnings is approximately 35 times, reflecting investor confidence in sustained high-growth cloud compounding.
Beta sits at 0.99, nearly market neutral, which is unusual for a high-growth software name. That low beta reflects Atlassian's mission-critical positioning. Engineering and IT teams do not cancel Jira subscriptions during market volatility. The stickiness of workflow infrastructure creates a natural volatility dampener in the stock.
Analyst conviction on Atlassian is as concentrated as it gets. 18 buy ratings, 2 holds, 0 sells, a nearly unanimous bullish stance that reflects both the quality of the Q3 beat and confidence in the cloud migration runway extending through fiscal 2027. The consensus price target is approximately $75, representing 9% upside from the current $68.59.
The primary analyst thesis is cloud ARR inflection. Legacy server customers migrating to cloud are not just replacing equivalent licenses, they are expanding seat counts and tier levels in the transition. The forced migration creates an upsell moment that Atlassian has monetized at a higher rate than the market initially modeled. Analysts tracking cloud ARR acceleration have been revising revenue estimates upward for 4 consecutive quarters.
Atlassian Intelligence is the emerging second act. Embedded AI features in Jira and Confluence, automated issue categorization, smart summaries, natural language project queries are driving enterprise seat expansion as IT and operations teams embed the tools deeper into daily workflows. Analysts estimate AI-native features could expand average revenue per user by 15 to 25% over the next 2 fiscal years.
On valuation, the 2.92 times price to sales creates an interesting setup. High-quality SaaS peers growing at 20+% typically trade at 5 to 8 times sales. Atlassian at 2.9 times is a discount that analysts attribute partly to GAAP loss optics and partly to the share price sitting below the $75 consensus target. 18 of 20 analysts see that gap closing.
The bear concern on the street is modest but real. What happens to cloud migration momentum after the server end-of-life cohort is fully absorbed? By fiscal 2027, the forced migration tailwind expires. Atlassian must demonstrate organic cloud growth through new logos and AI-driven seat expansion to sustain 30+% growth without the structural migration catalyst. That transition is the key watch item for the next 8 quarters.
The bull case is compounding cloud ARR at 30% with AI-driven seat expansion layered on top. Atlassian sells workflow infrastructure, the most defensible category in enterprise software. Once Jira is embedded in an engineering organization's sprint planning, compliance workflows, and incident management, switching costs are prohibitively high. Revenue compounds with headcount and product adoption.
Atlassian Intelligence deepens the moat. As AI features make Jira and Confluence progressively smarter, auto-generating project timelines, summarizing meeting notes, flagging at-risk tickets, the value per seat increases without increasing Atlassian's marginal cost per seat. That is operating leverage compounding on top of already 84% gross margins.
At $68.59 against a $75 consensus target, with 18 of 20 analysts at buy, the stock is cheap relative to the quality of the underlying business. A re-rating to 5 times sales, still below high-growth SaaS peers, implies a share price above 110. The FCF inflection from $1.21 billion, growing 20+% annually, gets you there.
The bear case begins with the migration cliff. The server end-of-life tailwind that drove 6 quarters of 30+% growth expires in fiscal 2027. If organic new logos and AI upsell cannot replace that cohort, growth decelerates, and at 35 times non-GAAP forward earnings, deceleration compresses multiples fast.
Microsoft competition is intensifying. GitHub is expanding into project management with GitHub Projects. Azure DevOps and Microsoft 365 give enterprise IT an integrated alternative to Atlassian's suite. Bundling economics favor Microsoft in accounts with existing enterprise agreements. Price competition there is real.
The gap loss creates perception risk. Negative 37 cents EPS in a risk-off tape can trigger passive selling pressure that disconnects the stock from its free cash flow fundamentals. Atlassian has no dividend and no buyback. In a market rewarding capital returns, the reinvestment model demands patience.
Net debt of $107 million is manageable but not pristine. If macro conditions tighten and IT budgets contract, growth assumptions compress alongside rate risk. 2.9 times sales looks cheap, but that discount reflects real execution risk on sustaining 30% growth once the migration tailwind is gone.
The closest structural peer is ServiceNow, ticker NOW. ServiceNow sells workflow automation and ITSM to the same enterprise IT buyer as Jira Service Management. ServiceNow trades at approximately 12 times forward sales versus Atlassian's 2.92, a gap reflecting ServiceNow's higher ACV and direct sales motion. A re-rating towards ServiceNow's multiple is the upside scenario if Atlassian deepens enterprise penetration.
Microsoft via GitHub and Azure DevOps is the primary competitive threat. GitHub has 45 million developers, a moat Atlassian cannot replicate. But Atlassian's Confluence Jira suite covers project management and documentation that GitHub does not address natively. Competition is real at the edges, limited at the core workflow.
Datadog, ticker DDOG, is the observability peer. Both serve engineering teams with margins above 80% and accelerating cloud ARR. Datadog trades near 15 times forward sales versus Atlassian's 2.92, a gap that could narrow as Atlassian AI features deepen engineering team stickiness.
MongoDB, ticker MDB, rounds out the developer infrastructure set. Both are cloud-native and growing above 20%. MongoDB's database is less substitutable than project management tools, supporting a higher multiple. The Atlassian discount to the developer peer group is the opportunity the $75 consensus target reflects.
Options activity around the Q3 print concentrated in $70 and $75 strike calls for June expiry. The put-call ratio dropped to approximately 0.65 pre-earnings, moderately bullish. Post-print, call volume at the $75 strike surged as traders positioned for the consensus target to be tested before the next earnings cycle.
Institutional positioning into Q3 was net long, low leverage, Most large holders accumulated between $55 and $70 over the past 12 months. At $68.59, the stock sits at the upper end of that accumulation range. The next leg higher needs new buyers at the consensus target, not existing holders adding.
Insider activity reflects the co-founder structure. Mike Cannon-Brookes and Scott Farquhar hold approximately 60% of voting power through Class B shares. Alignment is structurally embedded. Open market purchases at these levels are rare because the founders already hold majority control. What investors watch is whether the founders sell. They have not done so materially.
Atlassian has no buyback and pays no dividend. Capital allocation is entirely reinvestment into AI, cloud sales, and platform infrastructure. With free cash flow at $1.21 billion and growing, a buyback initiation in fiscal 2027 or 2028 would be a meaningful re-rating catalyst. That optionality is not priced into the current multiple. Atlassian posted 31% revenue growth, a 10% EPS beat, and $1.2 billion in trailing free cash flow. Cloud migration is firing. At $68 against a $75 target, the compounding story is not fully priced.
Watch cloud ARR in Q4 as the migration cohort matures and AI ARPU expansion in fiscal 2027. If both accelerate, 5x sales re-rating is the path. Risks: migration cliff, Microsoft bundling, growth miss. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.